All right, let's start. So Thursday, you got the bond question, right? So you're gonna be ready for that. I don't know how many of y'all are coming prepared, looking at the video in advance. You might as well, because you got to know it for the final, and then you have to know it for life as well. Any questions on paper two? It's due on Friday. I've given you essentially a week, which is 6 days and 23 hours more you'll get in real life. And plus I'm giving you the data. So hopefully you found a company. There are some interesting companies. I saw one today. There's a trucking company that's up a bunch after earnings release. So every week, I mean, this has been a really interesting earnings. So Tesla, Netflix, I mean, there's really interesting ones out there. So you can really sink into some of them. Meta was pretty interesting as well. Meta's, I mean, it's up, what, 300% in just a few months. So obviously the market's rethinking that stock. You've got conflicts going on in Europe and Middle East. You got the Fed meeting tomorrow. Everybody's going to watch tomorrow. Is that pretty important, right? Is there an employment report on Friday? It's the first Friday, so that's going to be pretty important. So if you're interviewing for jobs, you don't have to watch the meeting tomorrow, but definitely want to read good articles on it, not articles on, you know, kind of CNBC or Fox or whatever, but, you know, Bloomberg, see what they're saying. So you can say something constructive about it. If you're interviewing this week, you definitely want to know about Wednesday and Friday. If you're interviewing with a particular industry, then look and see who in that industry's reported earnings so you can talk through that. So anything like that gives you a huge edge in interviews. So just be kind of somewhat paying attention. But any questions on paper two? Is anyone finished your paper two? A couple of people. So it's a paper you could sit down on a Bloomberg machine and write it in a few hours. It's not as extensive as the other three papers. All right, let's talk stock valuation. So I showed you this last class, how the Motorand puts this together. So you have existing business, you have new growth, and then eventually you have steady state. That's the way Wall Street thinks about it. I'm encouraging my security analysis class to steal one of the models from Capital IQ. They have one on valuation that is a very typical investment banking format. If you want to see it, email me and I'll send it to you. And you have to be on Capital IQ to build it, but it's very traditional approach. What I don't like about it is the traditional approach is they go out 5 years. It's this model about 5 years. How many firms go to their steady state in exactly 5 years? I don't think Google or Alphabet's in that stage. Who knows where Apple is or these other firms, but why do they go out 5 years? That's just because that's what everybody does. Technically, what you do is you go out as many years until you hit steady state. That could be 10 years, could be 15, 20 years, but the traditional models go out 5 years. So it's a good model to know because if you're going to interview investment banking, they're going to expect you to know that model. It's a pretty common model, and Capital IQ has it set up amazingly well. I was showing my security analysis class. You type in, I think I was telling Alec about this. You type in the ticker and it brings in all the correct competitors, just like that for you. You don't even do that. All you got to do is change your assumptions. Some of the assumptions we'll talk about today. So if you don't like their risk-free rate, you can plug in your own. If you don't like their beta, you can plug in your own. There's places you can plug in your own assumptions and your own growth rate, but they have the structure set up very much like they would expect you to do as an investment banker. So it's a really good model. And then the discount rate. So that's your paper 3. You notice he mentions beta, so beta is pretty common. And we'll definitely be using beta in paper 3. Your paper 3 is going to be easier in previous classes because we don't have to make any adjustments to the risk-free rate. It's high enough, it's normal enough, so you can just bring that number in. So let's get into it. So when you're valuing a firm, the real key is growth. And what he wants you to do is step back and see if it's logical. So there was one point, I was reading an article, probably not today because Tesla's been struggling, but there's one point where they were valuing EV firms as if every one of those firms were going to have 100% of the market. The market was so excited about electronic vehicles. There's some in China, there's some, obviously Tesla. So these are the 3 questions he asked. does it affect the cash flow or not? So if the firm's talking about ESG, is ESG going to affect the firm and in what way? So it comes down to growth. ESG firms are doing well right now just because that's trendy and that's what everybody's buying. But is it actually going to affect what they're doing on ESG actually going to affect their cash flow? The duh proposition, for an asset to have value, it has to have a cash flow. So what is the cash flow? You got to think in terms of cash. And then don't freak out. Assets that generate cash flows early in life will be worth more. That's the time value money. If it's never going to produce a cash flow, it's worthless. Everything in finance is about cash flow. So think through, just don't get involved with the hype of a firm. Ask these questions. Does it affect cash flows? Will the cash flows be positive? So you got some of these unicorn firms that are worth $1 billion, have no earnings. How's that going to affect them eventually? So you look at Eli Lilly. Eli Lilly would not be a bad firm for you to do. So they got one new killer drug. I mean, I shouldn't say killer drug, but one new drug, which is the weight loss drug. There's a lot of data out there on how much they can make off of that, but there's a lot of competitors too. So I think it's possible the market's overvaluing that drug because they're assuming each of those companies, just like with the EVs, each of those companies can get 100% of the market, but they can't. And new competitors are going to come in, so you have to somewhat see, is the market overreacting to this? What I like to do with a firm is just take the absolute best case scenario. So like with Facebook, what I would do, or Meta, I would go every country and see what percentage of their population is on Facebook. And I would just go, what's the max each of those countries could have? What would that mean for advertising? It's pretty easy to forecast Meta because the advertising dollars move with how many users they have. So every country, and if I do all of that and do the best case scenario and the stock's still expensive, then yeah, it's just not going to work. Like the motor end told one of his students, is you realize your assumptions for Netflix assumes they have like 15 billion customers. And the world only has 8 billion people. So that's going to be a tough thing for them to get unless they find aliens or something to sell their product to. So these reasonable things is just what is the best you can do. Now, the Motoran, and I do encourage you to watch his videos. He's got 2 videos I really, really, really like. One is on storytelling, which is exceptional, and then one is on life cycle of businesses. But in a storytelling, he talks about how a firm like Uber, his valuation made it look really overpriced. And then someone came in and said, you don't understand Uber. Uber is not a rideshare organization. Uber is a logistics company. How to get stuff from A to B. That includes competing with DoorDash, but includes other things. It may include delivering stuff for Walmart. It may include delivering stuff for Amazon. So think broader. What if Uber took over some of UPS and Amazon Prime and other business? What would that mean for them? So he said, okay, well, that changes it. That changes the math. That changes my growth rate. That changes the business. Uber's done fairly well in Europe on delivering food to homes. I don't know how profitable that is. You're somewhat limited, right? How much are you going to pay someone delivering you a meal at home? You're going to pay $10 for that delivery? And how much are you going to pay for a rideshare from Uber? That's going to be $25, $30. The food is not quite as wonderful of a business, but those are the kind of things you do. So you ask each of those questions. It was hilarious. Ford Motor Company changed their name to a mobility company. And the CEO got fired somewhat time after that. No one was like, what does Ford mean that they're a mobility company? Does anybody know what that means? They're an auto manufacturer that issues a lot of debt, loans a lot of money. Mobility company, what does that even, what does it mean? What does it mean for Uber to be a logistics company? So that's what you're trying to figure out is what's the greatest this company could be? You think of everything together, and then that's going to be your max valuation, and you pull back on that. So the key for paper 4 is your growth rate. That's where you're going to spend most of your time. How fast can your company grow? Remember back to the motor ends model, you've got the existing business, it's got a growth rate, you got the new stuff that's going to add to the growth rate, and you have the steady state. So the first thing we start with is the steady state. Most companies at some point just can't have exceptional growth. They've done everything they can do. And you might say, well, Apple's not there yet, but boy, they're a $3 trillion company. So if they do something new, it's going to have to be fantastic to have any impact on anything else. They're going to have to come up with some new thing, and I don't know what it's going to be. I'm getting kind of bored with their iPhone presentations. Or are y'all like, can't wait to hear the next iPhone? My Spanish teacher, she's like, which phone do you have? I got 13. She's like, I got 11. I was like, yeah, they're both perfectly fine. What are they up to now? I can't even keep track. 16, 7, I don't know the difference. We saw the same thing with Microsoft. I remember at UTSA, Microsoft would update their operating system every year, and they made a fortune because every corporation had upgraded. But then a few years later, it's like, who cares? What I have is fine. And Intel, faster chips, faster chips. It's like, I'm fast enough. I don't have any program where I need to cut a tenth of a second off of my processing time. So there comes a point where even if your product gets better, it's too much for the customers. So you have to think through that. At some point, Microsoft, Apple, Google, they're all going to just be growing just normally. So what is normal growth? We can start with the U.S. economy. We already talked about that, right? You're going to talk about that when you do your discount rate because of the implied growth, and you're going to do it as far as your ultimate growth. So for Walmart, what is Walmart's ultimate growth? When Walmart builds every store they can build, they can't put any more stores down. How fast can they grow after that point? Well, they should be able to grow with inflation. Right? They can increase their prices with inflation. They should be able to grow with population growth. Inflation plus population growth, you see one other thing in there, which is productivity. Can Walmart grow with productivity? So as we find things that make us faster and more efficient, can Walmart incorporate that in the business and become more profitable? So I think U.S. economy is essentially their long-term growth. Now you might say, oh, it's only inflation plus population growth, because all this productivity stuff is not going to help Walmart that much, or if it does, they're going to pass it on in prices to their customers. That's the kind of thing you're thinking about. So I actually think for Walmart, their ultimate growth rate is probably going to be slower than the economy. But that's ultimately what you're after. Productivity, I say labor growth, but ultimately it's population growth. I'm assuming labor growth and population growth are highly correlated. And then inflation. I think the U.S. economy could grow at a 4 to 6% rate. I know this last GDP number is pretty strong, wasn't it? I forget what it was. 4 something, wasn't it? 4.3. And that's without inflation. So it was probably over 6, well over 6. I don't know what nominal. I should have looked up nominal. It was pretty strong, but then they reduced the previous one down to like 2 something. So, 4 to 6, we're right now in a pretty strong economic growth, but we also have pretty high inflation. We're coming out of COVID, so there's some unusual things going on there. You're noticing China slowing down. Why is China slowing down? They're not getting the productivity gains they used to get. So they're trying to transition this massive population from agriculture to the city. That's going to make them much more productive, but eventually you got all the people moved that you have moved. And so you can't get those 7, 8, 9% productivity numbers much anymore. So start with the economy. The nice thing about this is you're going to write about that in paper 3. So what you use in paper 3, you can then use in paper 4 for your growth rate. The next thing you got to think about is your industry. What kind of industry are you in? Is this a faster growing industry or a slower growing industry? And so I'm hoping you all know Porter's 5 forces. How many of you have heard of Porter? We talked about it in our class, maybe. I can't remember. Did y'all have it in marketing or in strategy? Man. So Porter's, when I had Porter, I thought, oh, this is a management class. I'll never see this again. And then I saw it all the time. Porter is very heavily used in finance, quite popular. I would know Porter if you're going to go into an interview. Can anybody name the 5 of them?
Yeah, the threat of new competition.
So barriers to entry,
Bargaining power of customers and suppliers.
Yeah, buyer power, supplier power.
And then drug substitutes.
Drug substitutes.
And then
Starts with an R. Do I have it up there? I probably do.
Yeah, rivalry.
Rivalry within industry, right? Those are the 5 things. It's a good list. Porter is an impressive person. I don't know if I recommend his books because they're intense. So I recommend books I can listen to on Audible. You can't listen. I listened to his last book on Audible, and it's just like he's so detailed. So I think of his books as more of a resource than just something you're going to read. So his book is industry by industry, company by company, very, very specific. So it'd be really helpful if you're looking at industry to get his book and see what he says about that industry. It'd be really powerful. So what he's asking is this industry, is it positive or negative? And that has to do with growth. So if industry it's really easy to get into the industry, that's going to be bad for growth because if they do well, all these new competitors are going to come in. There's a lot of rivalry within the industry. That's bad because they're going to be competing with each other for market share, cutting prices. That's going to kill growth. If the buyers have a lot of power, that's not good because the buyers can be able to negotiate their own prices. If the suppliers have a lot of power, that's bad because it's going to make their goods more expensive. Threat of substitutes obviously is what we call, I don't know if I have it in here, but threat of substitutes is this disruptive innovation. Are y'all aware of that? Boy, there's so many things. I have to tell you all these things. So let me. There's the mortar end. Nice guy, really is a nice guy. He's got a lot of streaming. His valuation one's very good. You could watch his equity risk premium one. It's only 2 months ago. You could see what he's saying about that because that's your paper 3. So you could do storytelling. So this one right here, the value of stories in business, really, really good. Give several examples there. So I highly recommend it. He says here, he has another one, maybe more recent here. Numbers and narratives. He might do the more. I haven't watched this one yet. And then his other one is the life cycle. Corporate life cycle, really, really good video, but I haven't watched all of his. He has other ones. I've gone through his entire 2 of his graduate courses. This guy, he shares everything for free. So he's not much of a finance guy, right? I probably told you all this, but he brought a textbook and he gave his entire class the PDF of the textbook so they wouldn't have to buy it. That doesn't sound like good finance to me, but nice guy. He just like wants to share stuff. So he shares a lot of stuff for free. His entire 2 of his graduate courses are out there for free on YouTube. You can watch them. I've watched them taking notes. They're really, really powerful classes. They're a really good professor. But yeah, this life cycle one is really, really good. And he says you have to have the right CEO for the right place you are in the life cycle of your business. Otherwise, you're going to be doing things that are stupid. That has a lot to do with Porter. Because there's a lot of Porter has to do with what stage the industry is in its development. Is it early on? Is it midlife? Is it end? Is it declining? Those are important to what he's looking at. The other thing, shouldn't have hit share screen. The other thing is can't remember his name, but here it is. This guy, Clayton Christensen. Highly recommend his books. He unfortunately passed away a few years ago. These are all good books, but yeah, this one right here, boy, it's an old book, but I really love this book. Seeing what's next. So when he's talking about disruptive innovations, how do you know some new technology, some new products going to come in and just wipe out another business? So how good of a job did Blockbuster do on that? Seemed pretty obvious. Netflix put it in their title that they're going to the internet. Blockbuster didn't see that. Why didn't Blockbuster do a home delivery? Well, they tried it, right? It just didn't work. It was too late. But they were the place you probably have, your parents probably went to Blockbuster. Seems stupid, doesn't it? You go to Blockbuster looking for videos. Now you can just go on YouTube and pay a couple bucks and watch a full-length movie, whatever you want to watch, or you get an account at Hulu or whatever. So he's asking, how can you see this coming? He does a really good job of saying, here's the signs that an industry is about to get disrupted. And what are those signs? And he says, here's the signs, here's when they're fake, here's when they're true. And so the obvious question to ask is, if there's a disruptive innovation, why doesn't the existing champion put them out of business? And he makes the point that usually the existing champion, like a Blockbuster, they're making too much money off of the existing model. They don't want to kill that model, and they're very slow. So you look at a Western Union, y'all heard of Western Union. So who was Western Union? They were a telegraph company. So Alexander Bell goes to Western Union and says, hey, you want to buy this telephone thing? And Western Union's like, no one's going to talk on the phone. That's stupid. Well, why did they say that? That seems really stupid. But if you look, they had so much invested in telegraph lines, it didn't make sense for them to disrupt that business. But the amazing thing is they're still in business today. So even after making the mistake, they're still around. But that's what he's asking. Some of his more interesting chapters are in education. I think education needs to be disrupted pretty in a major way, especially public schools and colleges. I think we've got to radically change what we're doing. But he asked that question, what's going on? You see people like Khan Academies, stuff like that. That's really, really interesting. So interesting stuff. Most of the chapters are readable until you get to the telecom chapter. And he must have telecom background because that chapter gets really technical, but all the other chapters are really good. But it's old. It's 20 years old. And I don't know what the last book he wrote, since I think he passed away like 2 or 3 years ago. Here, it's an interesting book. I read this book. He was taking disruptive innovation, but applying it to your personal life. What does that mean? So he's trying to take his theories of finance and make it for your own personal life. So there's a lot of reading you can do. These people's ideas are really quite, they're innovative, and they give you an edge thinking about the value of stocks, because they're giving you something to think about that almost everyone else isn't thinking the same way about. And then the idea of economic moats. Does this firm have some advantage that they can sustain to keep that advantage there? And economic moats are very similar to Porter's 5 forces. The biggest economic moat people talk right now is the network effect. The fact that having more customers gives you a huge advantage. So that's Uber, that's Facebook, those type of firms that once you have the 1 billion customers, no one else can compete with you because that's where everybody goes. I mean, if you were to try to start a rideshare business in San Antonio, how long would it take you? Your first problem is going to be getting customers, and what are your customers going to say? Well, do you have any drivers? Well, no, I got to get customer first, and I get to drivers. Well, it's not going to work. Then you go to drivers, and what are they going to say? We have any customers? Well, no, I got to get drivers first. This is the only way you're going to get that to work is you're going to have to pay drivers, lose money for like 3 years, and then you can compete. That's going to be really tough, isn't it? Because Uber's not even making money yet, and they're competing against you. So it's going to be a tough business. That's an economic moat is some sustainable competitive advantage. So you're trying to think about these in terms of start with the economy, and then how different from the economy is your industry and is your company. And that's where Porter's 5 forces come in, economic moats come in, sustainable competitive advantage. Porter is a big writer on all of these things. The other thing you can do, one thing I think Porter did that's really, really quite powerful. Let's say you're doing Apple. There's something Porter developed called the value chain. Have y'all heard of value chain? Really good concept. It's not coming up here. Value chain analysis. I like the idea. It's probably a little much for paper 4, but it's the kind of thing you would do. So I would research value chain, read some books on it. Again, Porter's book on value chain is about that big. But value chain is asking where in the process does this firm have their biggest advantage? So they look at just inbound. What are your raw materials? What advantage do you have that? If I were interviewing with HEB, that's what I want to know. I think that's the key to HEB. Any of y'all work for HEB? So you know how they get their stuff? Have you been involved like in the supply chain? The supply chain management is a big part of the value chain management. All right. It seems like HEB does that really well. They have contracts with farmers that are local. How do they do that differently than Walmart? And does that give them an advantage? Those are the kind of things you're asking that question. For a grocery store, they better be really, really good at that. If they can't get stuff on the shelves cheaper than competitors and good quality and all those kind of things, they're gonna have a problem. And then once you get that raw material, what do you do with it? Your operations, how do you get it, set up and ready to go? Outbound, how do you get it to the customer? What's your advantages there? Marketing and sales. And then once you sell the product, how do you handle the customer afterwards? That's the service side. So you're looking at each one of those. I was reading, doing the business breakdown on, is it HelloFresh? So HelloFresh, their CEO said he wants to be world-class in every single thing on that list. Usually what Porter says is you got to be great at one of these things. He said, we want to be, and his argument was, if you're going to run in the Olympics, but you pull a calf muscle in your left leg, you might say, well, that's just one muscle in one leg. You're not going to be a very good sprinter if you have one body part that's injured. So he said, we got to be Olympic at every single one of these things. Now, can he really do that? I don't know, but he uses value chain to manage the business, and he's looking at each one of those pieces. So there's just another way you can give yourself an edge in thinking about businesses. And the reason he puts margin in there is you can be great at all these things, but if it costs you a whole lot of extra money, you're not going to make money. You can't spend 50% more to become best if it only gives you a 20% price advantage. So you got to bring all that stuff together. So it's a great idea. So here's a value chain management on Apple. I don't know who wrote it. Could be some high school junior, who knows, but asking those kind of questions. So economic moat, does your company have a moat? I would definitely think about this in paper 4. Does your firm have something that not just gives them an advantage, but is sustainable? So obviously I mentioned Eli Lilly. What's their economic moat? What keeps their competitors out? The patents. And how long does a patent last? And pharmaceuticals have gotten really good at artificially extending patents by making small tweaks to their drugs and then getting it reapproved. They get this new protection. It seems unethical to me, but there's not a CEO here from a pharmacy to defend it, but they're certainly making some money that maybe is a little unethical, but that gives them an advantage. The platform effect we talked about, patents, brand ID is a big one. So if a firm like a Tesla has a brand advantage, I think Tesla is potentially making a mistake by selling these cheaper cars, because right now they have a little bit of that $70,000, $80,000 car, nice car. If you're driving that $70,000 Tesla, you want to see a $40,000 Tesla driving by. May not make you quite extinct.
The Model 3 has always been pretty affordable. And I mean, the Model Y is like one of those products like mid-level. So.
Yeah, I'm a cheapie, so to me a $60,000, $50,000 car sounds like too much. But you guys have better taste in cars than I do. But what does that mean? What if Ferrari introduced a $50,000 car? Would that make sense? That would destroy their entire brand, wouldn't it?
The Model Y is like beautiful, plus 25,000.
Brand new?
Yeah, and then plus the tax credit.
So how much worse is it than their top line?
Top.
If you were blindfolded and put in both cars, I mean they're autonomous vehicles, right? You get in it, can you tell the difference?
No, not really. I mean, like for example, we feel like the Model Y to the X is like slightly bigger and it's like a little bit faster. It's like not really worth it. The Model Y gives you way more bang for your buck than like that.
Yeah, so this is the issue. So the business breakdowns did Peloton. Peloton tried some cheaper models. That can sometimes destroy your entire brand. So you have to be real careful when you start coming down market and you've got a marquee product and causing problems. So you have to think through how important that brand ID is and can they destroy that brand. The business breakdown for Cinnabon, I thought was exceptional. Pat told, she understood her brand. So she said, hey, this is not a healthy product. It's a horrible product. It's bad for your health. We're not going to compete. We're not going to create a healthy Cinnabon. And so I like the way she said it. She said, if you're going to be bad, make it good. So she knows her product. It's an unhealthy product. You're not going to eat this thing every single day. But if you're stuck in the airport, my idea is my plane gets delayed, there are no calories. Calories don't count. Every food is 0 calories. I eat whatever I want because that's the only thing I can do in the airport that I enjoy doing. And she said, I've never eaten, any of y'all eaten a Cinnabon? You'd be bouncing off the wall. I don't know if that's what you want to eat before you get on the airplane. You'd be so nervous the rest of the flight. But they smell really good, don't they? So she understands that business, but then she had the idea of, well, can we franchise this? Can we co-label it with Pillsbury? Can we put it in the Burger King? Every time they had those decisions, she had to ask, what does this do to the brand? And her franchises were really upset. You know, you're doing all this licensing, you don't care about us anymore. And she kept telling them, no, you're the key to this product because that's where everybody smells the product. So every business has that. Once you have the brand ID, you got to protect it, but you also want to expand. And she said, we can't expand so much that we become a commodity. We just become another cinnamon roll. So every business has to protect that moat. I like one podcast I was listening to where they said if a firm has an economic moat, that better be where their CapEx is going. That better be what they're expending money on, that they're protecting that and fortifying that economic moat. So at the company level, you got to think about market share. Are they picking up market share? So the other end says it's a best industry, one that's growing fast, and you can just have a constant market share, so you just grow with the industry. The worst case is you have an industry that's not growing, and you're trying to pick up market share, because that's going to become a cutthroat battle that's going to be pretty intense. So you have to somehow put these two together. A growing industry, market share is not as important. A dying industry, market share becomes life or death because firms are going to go out of business. All right, so how can we get growth? All right, so I'm kind of confusing a little bit. So we got ultimate long-term growth, which is probably going to tie to the economy, and now I'm going to talk about short-term growth. That's where economic moats come in and those type of things. So how can get short-term growth? So one thing you can do, you could do this with Capital IQ. It's just bring in your firm, and you don't have to have Capital IQ loaded in Excel. You can do it online and just they have a process where you can click all the years and just download all of the financials, and then you'll get 10, 15, 20 years of earnings per share. You can just look at the growth rates. I should probably show you, maybe I'll do that next class, show you how to do that. It's pretty easy to do. I like to calculate a 3, 5, and 10-year growth rate just to see what's going, especially 3 years right now. You still have COVID in that number. So it's a little bit of a distorted number. So 3, 5, and 10. Walmart's a company where I think the 3, it's kind of hard to say, they're kind of getting far enough away from COVID, but the 3 still looks fantastic and the 5 and 10 look horrible. So that somewhat tells you something. You can do a rolling 3 years where you just do 3 years over and over and over again just to see what the trend over the long term is. So that gives you a historical perspective. If you have a firm that's never grown faster than 7%, it'd be kind of tough to say they're going to grow 10% unless you have something radical that they're doing. The second approach is, what is the market think? So there's a few ways you can do this. One is the PEG ratio. We'll look at the PEG ratio. The PEG ratio tells you what the market thinks the growth rate is going to be. You don't have to do the PEG ratio. Or you could do 2 approaches. Another approach is just get on the Bloomberg machine and look at analyst forecasts on Bloomberg. So I can't show you that in here, but let's look at the PEG ratio approach. So the PEG ratio is the PE ratio of the firm divided by their expected growth rate next 5 years. That's the PEG ratio. We can get the PEG ratio, we can get the PE ratio, which means we can back into the growth rate for the firm. So that means the growth rate on the firm is just their PE ratio divided by their PEG ratio. So let's look at, I don't know which firm we're going to look at, but there's that firm I was talking about, XPO. There's their 5 days. Can you tell when their earnings were released? Anybody? Kind of hard to tell. Was it
Positive report or a negative report? Looks pretty positive, doesn't it? All right, let's try Walmart. So Walmart, we look at statistics. I'm gonna go to this column here, not the current. So don't use the current column because it can be somewhat distorted. So you get their forward PE. I don't know why that's taking so long. All right. And then we get their PEG ratio. You see what it says on the PEG ratio, 5-year expected. So the PEG is 3.57. Now there's people out there to believe you should never buy stock whose PEG ratio is higher than 1. Some say higher than 2. Walmart's higher than 3. I don't quite agree with that definition because it ignores interest rates and inflation and other things. And then it has to be the forward PE ratio, not the actual PE ratio. The forward PE ratio is 25.77. And so expected growth you just take 25 to divide by 3, and you get 7.2. You can divide by 100 if you want to. They expect Walmart to grow about 7.2% the next 5 years. Does that sound excessive? Reasonable? They're doing some interesting things. Their internet's starting to work. They've got the order and pick up at the store kind of things. So maybe that stuff can work. Amazon's has been struggling a little bit on the retail side. So maybe that's a good forecast. That's Walmart. Let's try Amazon. So their forward PE is 40.49. And their PEG is 253. So their expected growth is 16. Does that seem reasonable? That seems pretty excessive. Where does Amazon make money? It's not from retail, it's from AWS. And there is a really good article talking about them spinning off AWS. I don't think they want to do that because they want control of that business because they need it so desperately. But that's a very profitable business. What would happen to Amazon if they spun off the AWS? It looked pretty pathetic, right? Especially compared to Walmart, not nearly as profitable. But 16%. So this is something you could do in paper forward that would be really interesting is don't just get this for your company, but bring a few competitors in. Is there a huge difference between Home Depot and Lowe's? You may not be able, if they have negative earnings, you can't do the forward. Well, the forward PE would probably work. So that would add some insight to your firm. I mean, let's even try that. It could be interesting. You would expect just without even thinking about it, they had very similar growth. What do you think? Is there a radical difference in these two firms? You might say one has more stores, so they can't grow as fast. Their forward PE 22.27, 22.27. Someone remember the 219. What was it? 219. So that's a pretty high growth rate. And then we do Lowe's. 1779 and 150. I can't remember that. They have Lowe's higher than Home Depot. I would then want to look at the recent growth and see if maybe this is some catch up. I'm going to talk in Investment Society more a lot about pair trades. I like I like it when two companies that normally move together and they suddenly separate. That really gives me an interesting perspective. We've seen that a lot with Home Depot and Lowe's. Lowe's was doing really well, Home Depot not, and then they caught back up, and then so it's interesting. The market has a huge difference. This is not that radically different. This is obviously much different. So the PEG ratio is one approach. You can also, when you go into Bloomberg, in Bloomberg you type EE, earnings expectations, and they will show you, and I changed it to annual, don't use quarterly, I changed it to annual, and they'll show you what people think growth rate is going to be in the next 5 years. You can use that, that can add a lot of weight to your paper. So you might do the PEG ratio and then use Walmart, Bloomberg. They may not be the same expectations. They're not all the same people. So you can get different numbers. The one thing to be careful with Bloomberg is how many analysts there are. So if you go and have 5 years and only one analyst, you may not have a lot of confidence in one person's forecast. So you can certainly do that. So the second approach, so you start off, approach one is look at their history. Approach two is ask, what is the market thinking? Now, obviously your boss doesn't want you to use that because why are they paying you? You just can use everybody else's expectations. But it gives you somewhat a ballpark. And it also helps you, it's powerful in the paper to say the market is implying a 10% growth rate, but I don't see how they're going to get that. I think the stock's overvalued. It lets you kind of put your forecast against the market, which is what your boss is after. If you want to say stock's overvalued, then you say they're expecting too high a growth. And so it's a powerful extra tool to put into your paper. The third approach is the traditional approach, which is what we call sustainable growth, which is a formula. It's a pretty basic formula. So sustainable growth is how fast could this firm grow if they don't go out and issue stock, they don't borrow money, just exist. How much can they grow just based on their current operations? And sustainable growth equals return on equity times retention. Return on equity is a number you can get out of Yahoo Finance, but I recommend you get it from Capital IQ because one thing to put into your notes, those that you're taking notes, some of y'all are just kind of staring at me, but one thing you can put in your notes, it's not just ROE, it's normalized ROE. So if your recent ROE is like 87% because something radical happened, you're not going to use 80-something%. So you look over the last 3 or 5 years and just see what would a normal ROE be. So it's real important on this ROE that is normalized. You can do the same thing with retention, normalized retention, because some firms like Costco have really bumpy dividends. So you might want to look over 5 years and see what that is. So return on equity is just their net income over their equity of the firm. Retention is what percentage of their earnings do they keep that they don't pay out in dividends. So a firm like Google or Alphabet, it's 100%. They don't pay any dividends. So some firms is 100%. Other firms, it can be 40, 50%. A typical S&P 500 firm will pay out about 40% of their earnings in dividends. So 40% is the norm, which means retention, 60% is the norm. So you just take dividends divided by earnings per share, dividends per share over earnings per share, and that tells you how much they're retaining. This is a mathematical formula that is absolutely correct, assuming their ROE stays constant. But most firms' ROEs are all over the place. So their productivity is going up, their turnover is going up, their margins are going up. It's not a good number, but it is absolutely true. If their ROE stays constant, they will grow at this rate. It's just a mathematical truism. So I wish I had Capital IQ set up here, but we can do Walmart here real quick, or we can do Lowe's. So for Lowe's, you see their return on equity somewhere. Here it is. Return on equity is NA. Why is that? That's because they don't have equity. Their equity is negative. So that's one thing you might want to avoid in paper 3 and 4 is a firm with negative net worth. And there's a lot of them. McDonald's, Starbucks, Lowe's, I think Home Depot was as well. Papa John's. There's a lot of firms with negative net worth right now because they're buying so much of their stock back. Look at that. It's now negative $14 billion. According to the accountants, Lowe's is insolvent. I doubt that they're actually insolvent, but so we'll do Walmart. So I'm going to go to statistics for Walmart. Their return on equity is 16.33%. their dividends and earnings per share. Well, actually, I don't even have to do that because they show you here. If you look down here, they actually give you the payout ratio, 43.46%. They just took dividends per share over earnings per share. Real straightforward, probably on the annual basis. So 43.46. So what is their retention? 1 minus that. So 50, they retain 56%. So the theory is if they pay out 40-something%, they can't use that money to build new stores. It restricts their growth. They can't grow that fast. So all they can grow is what they retain, reinvest into the firm, which is 56%. So what does that give you for expected growth? And even better, sustainable growth. Just take ROE times retention. You get a little bit higher number, 9.23. But here on Walmart, I would probably won't let me bring in some multiple years. I can do that. I just realized I do have that file. So how many of y'all are using Capital IQ? Keep mentioning it. So you should be an expert in it. So make sure you get it on your resume. I was showing Alec, there's a really good YouTube channel, and if you've gotten into it yet, but the Corporate Finance Institute has a really good Capital IQ tutorial, all free. I'm hearing Capital IQ a lot these days. So here's their earnings per share somewhere. I'll see it in a second. Or just search for it. So let's look at some growth rates and just see. So you get some historical data. Does that look like a firm that's going to grow 7 to 8%? The average the last several years is 5.9%. That doesn't sound too convincing. So let's try. Let's try a 3-year, 5-year, and 10-year. So how do you do growth rates? CAGRs. So a CAGR is ending over beginning raised to the 1 over n minus 1. So how do we do 3 years? Well, the current year is 528. How far back do we have to go to get 3-year growth? Don't say 3. You have to go back 4 years. Because you need 3 growth periods. You grow from year 4 to 3, 3 to 2, 2 to 1. That's 3 growth periods. You go back 4 years, raise it to the 1 divided by 3 minus 1. So that looks pretty good, doesn't it? 8.93. Last 3 years, they've gotten some pretty good growth. What about the last 5 years? How many years do I go back? 1, 2, 3, 4, 5, 6. Raise it to the 1 over 5 minus 1. That looks pretty good. 7.4. Go back 10 years. How do you think 10 years is going to look? 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. And then they're not even keeping up with inflation. So the last 10 years, that includes the last 3 and 5 with all the COVID impact. Even with all the last 3 and 5 with their incredible growth, over the last 10, they've only grown 1.5%. Inflation's probably been 2.5%, 3% during that time. Not much growth. And you think, well, they're not keeping up with inflation, but it's worse than that. Have they added any stores in the last 10 years? When you think they grow with inflation plus store growth?
Wouldn't they just grow with that? If you add 10% more stores, wouldn't you expect your revenues to go up 10%? So I know they've grown stores. We could even look at the growth in stores, probably somewhere in here. I don't know where stores are. Somewhere in here, I probably have stores. I can't remember. But doesn't look too promising unless something radical. Now, 10 years ago, they were battling with Amazon. Amazon was winning. Although Amazon wasn't profitable, they were still winning as far as picking up the customers. So the market seems to think the recent history with all the COVID impact is more indicative of the next 5 years than the 10 years. If you disagree with that, then Walmart stock is probably grossly overpriced. The other thing we can look at is ROE. So if you look at their ROE, what is their normalized ROE? It's been pretty strong. It's averaged 16%. The current number, I forget what it was. Was it 20 something? Can't remember. Oh, 16. So 16, the current is 16, the long term's been 16. You don't really need to normalize it because the current ROE is pretty close to what they've done historically. So you can certainly look at that. You can also look at here's their dividends per share and their earnings per share. So you can just take their dividends per share divided by their earnings per share. You see a normal number there. It's average 48%. I use 42%. So is it lower now for some reason? Their dividends are essentially, they increase it a penny every year, or 4 pennies every year, a penny every quarter each year. So it doesn't seem like they're increasing their dividends as their earnings increase. They're just increasing it a penny every year. So that's the kind of things that you can see. I got all of this from Capital IQ. Matter of seconds. So once you learn Capital IQ, it's really easy. You get the firm set up and you just go in Capital IQ, look for those 4 fields: earnings per share, return on equity, dividends per share. It's easy stuff to bring in. So the historical CAGRs right there, or you can even just graph it over time. So their average over the long term is 5%. That still seems really unimpressive to me because I know they've added a lot of stores during that time. So I don't know why a company would have a growth rate that's slower than their store growth. So yeah, it's not a great story for Walmart, but recently they have done better. Obviously, COVID was a huge benefit to them. The negative 9% this current year is probably because they came out of COVID, although they had some interesting subsidiary transactions going on as well. So, oops. Okay, thank you, Bill Gates. I'm not sure why you did that. All right, so that's the third approach. You got to normalize the number, but it gives you a good sense. And you look at all those numbers together. The history, recent history, good. Longer term history, slow. PEG implies 7%. Sustainable growth implies 8%. Historically, they've been, only about 5% on long term, but those are all things you're going to put together. And then what is the right answer? There is no right answer. We're talking about forecasting the future. I love emails from students when they ask, where do I get the growth rate for my company? When you get into a time machine, you go 10 years in the future, you get I'm not forecasting the future. That number doesn't exist. So the question isn't what is the number? The question is, what is a rational approach for coming about there with that number? I give you 3 ways that you can at least get a ballpark of what it could be, but you can seriously disagree with that number. You want to forecast NVIDIA right now? So the market went crazy with them because their growth was just ridiculous. I don't mean earnings growth, their revenue growth was ridiculous. You don't usually see revenue growing that fast. you might see earnings double in a year, but revenue growing that fast. But now they're starting to get some competition and some questions about, how sustainable is all that. That's a tough company to value. Walmart's a little easier to value, a little more straightforward, but even Walmart's going to be tough to come up with a number. So that's going to give you your short-term growth. Your long-term growth is probably going to be tied to the economy. So then the only thing you have left to do is how long will this growth period last until they become a long-term growth story? Now, you should probably pick a company that has something interesting going on right now. Because is it possible there are firms that are already at their terminal growth? So I think about a Campbell's Soup. What's Campbell's Soup doing that you're rushing out to buy their product right now? Have y'all heard that conversation? Hey, man, we got to get to the store. I got to get some Campbell's. That doesn't happen, but they probably did well during COVID. You got to feed a family of 5. You normally has been feeding them at the school cafeteria and at McDonald's. And now you got to cook from them at home. Campbell's is a really good solution, isn't it? Although HEB tomato soup probably is just as good. But they've tried some new products, and it's just really tough to get people to suddenly start buying more soup than they have historically. Campbell Soup, now they bought another firm, so they have some new products, but they had to spend a lot of money for those firms. So it's possible a firm like that is already at their terminal growth. So you want to find a firm where there's something interesting going on, at least in the near term, that gives you something to work with. And then how long are you going to get from short term? So if your short-term growth is really high, 10 years is a long time. If you look historically, most firms in high growth, they have a tough time sustaining the high growth more than 10 years. Amazon, Intel, now Microsoft did it for a while and then slowed down, and now they're doing it again. So they kind of have a second wave, which it'd be really impressive if they become the largest stock in the S&P 500, because I have to look back how many firms have done that twice, that separated. I think Microsoft's gonna be the first one if they do it. So they were the largest stock. Oh, when was that? In the 90s, I guess. And after they hit number 1, they've sold off pretty dramatically. So maybe they don't want to be number 1 again. Apple's been up there for quite a while. If Microsoft does it again, that's pretty impressive. Why? Because they reinvented themselves. So think about it. You look at an IBM. What is IBM? Y'all don't even know who IBM is. Y'all know IBM?
International Business Issue.
But y'all know what they do? What is IBM?
Watson.
A what? A what company?
Right.
Yeah, I think of more consulting, but they may be. But they have some AI products. They're the one that has Watson, right? Watson was the one that competed with on Jeopardy. So they're one of the early AIs, but you don't hear them talking about an AI today. They may be consultants or logistics on how to put AI into your firm, but they used to be a hardware company. Everything UTSA bought that was a computer, they bought from IBM for a decade or more. IBM was the largest tech company in the world, and number 2 wasn't even close. And that's no longer true. They sold off the computers, they sold off a lot of stuff. So can IBM reinvent themselves again to suddenly get high growth, or is this a dying company that's going out of business? It's interesting. So every firm to me is interesting, because every firm, you're talking about forecasting out the next 100 years. So if you have a great company like a Microsoft that's doing really well, don't think they're going to grow fast for the next 30 years. It's just not going to happen. It's really, really tough. No way Apple's going to have high growth for the next 30 years. So, and some people say, well, what about Microsoft, Intel? And so you mentioned a few that maybe went 12 or 13 years, but yeah, those are the exceptions. Out of thousands of companies, yeah, there's 5 or 6 that have been able to do that. So it's unlikely the firm you're looking at is going to grow 30% for the next 10, 20 years. It's just not going to happen. All right. So those are the growth rates you need. You need the short-term growth, the terminal growth, and then the time to get from one to the other. That's the focus of your paper 4. And I gave you those 3 approaches for getting that short-term growth, and then the long-term growth, you're going to tie back to paper 3. Questions on growth? Remember what we did on exam 1. What is a stock? Expected return on stock, dividend yield plus expected earnings growth.
That's what you're buying when you're buying a stock, is that expected earnings growth. And I don't mean over the next 3 years, next 5 years, I mean over the next 500 years. We'll see that. If you're gonna forecast a Google, you've got to go out 100 or 200 years to figure out the value of the firm. It's pretty amazing. All right, y'all got that? And I can't remember what I did in y'all's class, JJ. We did something along these lines. All right, so let's talk. So paper 3 and 4, you don't want to worry about it until after Friday, but after Friday, you want to start working on it. It's a little more involved paper. Paper 3 is your discount rate. Paper 4 is your valuation. Paper 3 has 3 inputs, and maybe want to guess what those are. What do you need for a discount rate?
The interest rate, like you're going-
Risk-free rate, beta, market risk premium, CAPM. So that's paper 3. Most of paper 3 is going to be on your beta. And the risk-free rate's now a piece of cake. You just use the 10-year treasury, so that's easy. The model we use from Capital IQ, they use like the 1-month treasury, but they have a drop-down button that you can pick the 10-year instead, but they have it set up so you come in with the 1 month. The market risk premium, we're going to talk a little bit about that today and Thursday, so you get ready on that. And in paper 4, we just essentially talked about that. So what I do for paper 3 and 4 is I have a video where I do the entire paper 3 and 4, but for Walmart. So guess which company you can't pick for papers 3 and 4. Walmart is off the table, so you can't do Walmart, but you could do Costco. I actually would recommend you pick a company on business breakdown, so you can add a lot to your paper. Business breakdown is exceptional, and they've got Costco. They have AutoZone. AutoZone is really, really interesting, but they have negative net worth, so it kind of messes that up. Yeah, I've got a list of companies. I'll have to send you all that list. A list of companies on business breakdown that will work really well for papers 3 and 4. You don't have to do that, but they do such a good job of really synthesizing what this company is all about. That's going to really help you, especially in paper 4, to understand what possible growth they might have. All right, so let's talk about the discount rate. So the discount rate, we're going to use capital asset pricing model. You don't have to write paragraphs about CAPM. You know, on a paper for your job, your firm either uses CAPM or it doesn't. So you don't want to insult your boss by explaining what CAPM is. They're going to be like, yeah, I went to school too, I know that. So you're just accepting it. You almost don't have to say anything about it. You might just say, using a capital asset pricing model to come up with a discount rate, and that's about all you got to say. And then you just got to go right into it. So the risk-free rate used to be an issue because the interest rate was so artificially low. So I probably should update my notes because this is no longer true. The 10-year treasury, the last time I checked, its median was 4.5%. It spent 50% of its time above 4.5%, 50% of its time below 4.5%. Where are we right now? Like 485. So we're pretty close to that median. So there's really no reason to adjust it. So it makes it really easy for you. Now, I would probably add to my paper a chart of the 10-year treasury just to show that we are back to normal. That's pretty easy to do. How would you get the 10-year treasury? There's a couple ways to do it. One is just H15 and data download, historical data. So H15 gets you the Federal Reserve. Data download, you just keep clicking until it stops clicking, and there's your download. And when you do that, you get the 10-year treasury back to 1962. You can do a nice chart on the history. The other way I like to get data is 10-year treasury and then type Fred. What is Fred? St. Louis Federal Reserve. So a lot. You also be using Fred all the time. And it's wonderful. I mean, we talk about productivity. You might want to do a productivity chart in paper 3. You do productivity, Fred, and there it is right there. You got to find, let's do this one right here. And you got productivity back to when? 1950. But you want an Excel. How would you get this into Excel? Right there, right? You might edit the graph. I want this I want this to be percentage change from a year ago. I'm going to do monthly, annual. Then I'm going to download it. Right there, I've got a lot of data that I can use. This doesn't look like the right data, so I'll pull the wrong thing. So you do it right the first time, but you can get some really good data. But you can do the same thing with the 10-year Treasury. And you can do max. So you can see how the 10-year Treasury is getting back to normal, looking at this. The reason I like this is if you take it to age 15, they bring in all the holidays with the NA. So you got to get rid of all those. Here, you don't have to do that. All the holidays are out. So you can definitely see that we're back to our normal 10-year. You could put the median. I wouldn't put the average because the 80s, 70s, and 80s are going to really skew that average. But you could put the median in there as a line and just show that we're above the median. We haven't quite hit 5%, but we haven't been at 5% since 2002. And then before that, you can see it was pretty normally below that. You can go back to 1871 on the 10-year Treasury if you want to. Robert Shiller has it back to 1871. I don't think 1871 is really appropriate because I'm not sure U.S. government, as an economy, we're a AAA rated economy in 1871 coming out of the Civil War. So it may be an emerging markets country at that point. But data is pretty easy to get. Should you add that to your paper? If it tells the story, yes. If it doesn't, then don't. So some students can do everything I say to do, but no, do what you should do to make your boss smarter. So you decide what goes in the paper. Start thinking on your own about what you should add and not add. When the interest rate is too low, I tend to normalize it. One way I like to normalize it using the forward curve. It doesn't really help here, but the forward curve at least gets you out of all the noise of whatever's going on currently, like COVID, and see what does the market think the 10-year Treasury will be in 5 years, and that can be a good approach. But you don't really need it for this paper. But the reason I like the 5-year forward is you should know how to do that. So I have a video that shows how to do that, and you can teach yourself. Right now, it's pretty boring because the yield curve is so flat. The forward curve is about the same as the current curve, is at least 10 years and out, so it doesn't really help. Dammit says use the current 10-year, and that's essentially what I'm recommending. So the risk-free rate has gotten much simpler, but you might add a little bit extra to that. All right, so then the risk premium has two pieces, the market risk premium and the beta. The market risk premium applies to all stocks equally, with one exception, and then the beta applies to your company specific. So the market risk premium is for U.S. large cap stocks. So when does the market risk premium not apply? Non-U.S. company or small cap. All right. So if you pick a small cap company, you may have to add a little bit more to your market risk premium. Small cap, you normally add a lot, 1.5% to that, but don't do a small company. Do a company over 20 billion, and you'll be fine. So this applies to all stocks that are large cap U.S. stocks. If you go outside of the U.S., it's actually pretty easy to get the numbers. So who's my favorite New York Stern School of Business professor? He'll give it to you. So you just go to his website. He has a market risk premium for every single country. That's pretty cool, right? So if you did a non-U.S. company, you just go find the company and see what else you could add in there. He has a small cap premium as well. You can look that up. He just provides all of that for free. I don't know what date this is, but he usually keeps them pretty up to date. Yeah, it's a couple of months old, but pretty good. When you come to the United States, you're going to see that it's 0. And the reason it's 0 is this is the risk premium you put on top of the United States. So their country risk premium is 0 because you're using their market risk premium. And so their market risk premium is 5%, but the country is 0. So all these other, like you see right here, US is 5%, you add 91. So what is that country's risk premium? 591. Same thing here. So this is the country risk premium. This is the US plus, I mean, this is the additional risk premium you put on top of the United States. All of that data is out there for free, and he's done all the work for you. So just remember, that the Mortaran, he provides a lot of stuff to you, and you can trust it. He knows what he's doing, so it's not a bad approach. But most of you are probably going to choose large US companies, so you can just use. And you saw his risk premium was 5%. Is that the right number? You got to come up with your own number. So on Thursday, we'll go through this. We're going to talk about the implied approach and why I use the implied approach now. And then we'll make pretty good headway for papers 3 and 4. So that's all we have left is the final exam on papers 3 and 4 once we get past paper 2. So, all right, any questions on anything? All right, real quick, I'll just work it just to save time. This is something you should know off the top of your head if you're a finance major. So we know the base is 1,000. The coupon is 7%. The risk-free rate, the 2-year is 4.05%. The spread, 88, right? Triple B, 2 years, 88. There is something unusual here where the 1 year is hard into 2 years. I don't know how I'd mess that up, but I guess it's possible. So the discount rate is 405 plus 88 divided by 10,000, so 493. The effective is 1 plus that divided by 2 raised to the second minus 1, 499. And then you got time, cash flow, discount factor, DCF, 0.51, 1.52, 35, 35, 35, 1,035. So 1038, I saw several 1038s, 97, 98, 99, several good. I gave you way too much time because it would take like 30 seconds. So it's pretty fast. Easier on Excel, obviously. But so if it takes you more time than it took me just doing an Excel, you're way too slow. So I'm a dinosaur, I'm slow. You should be twice as fast as I am. So we should have races in the FSC. And if you don't beat your old professor, you need to go back for remedial Excel work because you guys should be a lot faster than I am. All right. Okay, one thing I want to talk about because I've seen this in a few of the practice. So this paper 2 is a very common paper that you can see in a job early on. So let me just pick one. Let me pick Abbott Labs. Just the basics. Some students are struggling just with the basics. So on earnings per share, we can say they reported 0.8898 earnings per share, 1.14 after adjusting for whatever, I don't know what that is, which is 3.5% beat over the $1.14. I mean, sorry, $1.02 expected and slightly lower, 0.87% than the $1.15 reported same quarter last year. How many sentences is that? Do you need 4 sentences to say that? I've seen some students that, you're still in this thing is I got to get more pages. I got to get more pages. That's 1 sentence. They reported 89 cents earnings per share, $1.14 after adjusting for whatever it adjusted for. And at that point, you never talk about the 89 cents ever again. All right, it's the adjusted number that matters, which is 3.4% beat over the $1.02 expected, but slightly lower, 0.87% than the $1.15 reported same quarter last year. Everybody see how all in one sentence? I got everything in there. I got the dollars, I got the percents, I got current versus prior. So in talking the sum, it gets a little confused. You should start with the dollar, well, the $1.14, the 89 cents dollar. You start with that. What did they report? Some students like this mystery novel. The market was expecting this, and where they're going to get this, and all this, and then finally say, but no, they actually got this. That's great if you're, Hemingway or somebody, but in finance, your boss was to know, what did I make? What was expected? What was last year? You want to just get to the point, all right? In one sentence. How different is that from revenue? So they reported 10.13 billion. We don't have to worry about in revenue, which is 3.4% beat over the 9.806 billion expected, and slightly low and lower, not slightly. And here I might say, but lower 2.56% than the 10.41 reported same quarter last year. Could you take what you said about EPS and copy and paste it and use it for revenue? Yeah, do you really need radically different sentence structures and orders? Does that make sense? What does your boss want? They want obvious, right? So I would just, is it boring to write it like that? Well, boring is fine if you're just conveying data to your boss, all right? So do I count off to give me 4 sentences instead of 1? Well, on clarity, yeah, you may lose a few points. If it takes you forever to tell me what happened, yeah. The exact same thing with gross margin. It reported a 55.053% gross margin. Here, I'm not going to talk about the actual versus, it's just not that big of a deal on margins, which is a 99 basis point miss from the 56.047% expected, and 85 basis points lower, and I'll put a dollar sign with gross margin, and the 55.9. Almost the exact same sentence again, isn't it? All right. So I'm kind of penalizing for being too creative, because you don't need to be, when you're reporting facts, just data, you don't need to be creative. Just report the data. Same thing on EBIT, same thing on EBITDA. Y'all see the pattern there? All right. I had one company. Joshua, is that yours? What were you doing? Carnival. Yeah, I meant to put NMF there on Carnival. If you go from negative to positive or positive to negative, there is no percentage change. You just say they went from negative 58 cents to a positive 86 cents. You just have to talk the numbers. You can't say negative 200% because you don't know if you're going from positive to negative or negative to positive. So you just say the dollars. There's a couple of stocks that I accidentally had NFF because that was what was there last time. I forgot to put the formula back in. So I fixed that. I keep fixing them. So I keep finding ones. I try to find them all, but obviously a firm like Carnival, it's going to be massive. Even though 2022 is still out of COVID, I mean, it's still not that much out of COVID. it's, it's still amazing me anybody's doing cruises anymore, but they seem to have been doing well here pretty recently, and that's a pretty good recovery. Now, I don't know what this is. If I were Joshua, I might go back and see, get on Bloomberg, go back and see what this was in 2019, because obviously you want to ask, are they better or worse than COVID?
It beat 2019.
Yeah, if they're above COVID, that's a big deal, isn't it? You're seeing that with airlines. You see that a lot. And so we're already back above where we were pre-COVID. Restaurants, the same thing. People are asking these questions. There was one article, I think, in The Economist or Yahoo Finance. They were saying, boy, we must be back above COVID at restaurants. And the article was saying, no, we're not. We're not above. What the problem is, there's not enough workers. And so restaurants are busy and crowded, not because they're above pre-COVID, it's because there's not enough workers. So there's a shortage of workers, so they have to turn people away. That's a different story. So those are the kind of insights you're trying to provide in your paper on these earnings reports. All right. So I just want to make sure you have the basics in there, because each one of those is a point or several points. And if you miss something like you're missing really obvious points, and I'd hate for you to do that. Questions on paper 2? All right. So you'll finish paper 2 tomorrow at 11:59 p.m. and submit them. And then you can start talking about papers 3 and 4. The nice thing about papers 3 and 4, if you go to my YouTube channel for our class, there's a nice video. You got the paper 2 guide, but you have a nice video for papers 3 and 4. So you can actually write papers 3 and 4 while you're watching that video. That video values Walmart. So you can't do Walmart for your company, but you could do what you're doing for paper 2. If it works, you could value any of the companies. I think most of them work. You'd have to look and see. But it's an hour-long video, so it'll probably take you longer than that to write the paper, but you can at least pause it as you go through. I build it in Excel, so I'm not writing the paper. I'm giving you everything you need. So you'll have everything in Excel, then you'll have to transfer that into a paper and explain what you did. But it's all there. This thing has gotten a lot of views, so obviously someone besides the class is watching this. I don't know who'd be watching this. It's not a bad video for any basic person who want to value stocks. It does have everything you need. But let's talk about that paper. So we need a discount rate for stocks, risk-free rate plus the market risk-free premium times the beta. We already talked about the risk-free rate. Pretty easy right now. You just use the 10-year treasury, which has actually rallied here a little bit, hasn't it? I mean, it's been an amazing couple of days. So why is the market moving right now? What happened yesterday? Yeah, Fed, was that positive? So didn't raise rates. He sounded pretty optimistic. Things are looking good. Inflation's come back down. He had a few kind of quasi-negative, but we had a strong day yesterday. Today how big of a day is that? Almost 2 sigma day, right? 193. Interest rates, what's that? Almost another 2 sigma day, and they're both going in the same direction. Normally they go in opposite directions, but now bond markets are rallying, stock markets are rallying. That usually has something to do with inflation. This is kind of the 1980s, right? In the 1980s, the Fed's getting inflation down, the economy's doing well, everything's going up. That's kind of what we're seeing. Only 2 days isn't a market, but we don't know if we can continue it. But that's a really strong. I was really excited to see my mutual funds up a bunch, my bond mutual funds. That's kind of nice, finally. So it's been an incredible day. Couple of days here after October, right? October, we had 3 months in a row with negatives, which is not unheard of, especially in 2008. It was like every month, but 3 months down. So maybe November will be up. What does the market normally do in December? Usually you have the Santa rally. We'll see if that happened this time. We got that when I was at UTSA in 2008, because we were hedging stocks. We were down about 9%, and I said, take all the hedges off. And my boss was scared to death. We met with the CEO, and And the CEO said exactly what I knew you would. He goes, Joe Robles is a great guy. He says, hey, if you buy stocks, you can lose money sometimes. My boss is like having a heart attack. And he's like, yeah. And this is a guy who's first year as CEO, everything's crashing. And he's like solid as a rock. And the market was up. So we ended up making money that year because we took the hedges off. So that was a December rally. You could go back historically and see how each month does. Most people think October is the worst month, but it really isn't. It's where the biggest crashes have happened, like the Great Depression in October '87, but it's actually a pretty decent month. So you can go back to look, but then you have to ask, is that pattern still true? There used to be a presidential cycle where stocks, all the stock return all happened in 1 year of the presidential cycle, the third year. That's disappeared. Ever since Obama has disappeared because the Fed has been so different after the 2008 crisis, it's kind of destroyed that. But, you know, you can certainly look and see, does the calendar tell you anything about markets? What do we know about December versus January? Anything happen? Is December important versus January? Anything important happen? What do you do in March and April? You do your taxes. Does that influence people? What else is December? That's when you have your big reports to your investors. So you do some window dressing. So there have been patterns in December, January. So now we're in November. When we have a pattern in December where people do certain things. Normally, historically, small cap have done poorly in December and well in January. Anybody want to guess why that is? All right, so the theory is in December, portfolio managers want to have the NVIDIAs or whoever's done well that year. So they sell the small cap and they buy the large cap. So it's in their portfolio in December. And in January, they sell those and they go buy the small cap that they wanted anyway. And that's created this kind of January effect. That's disappeared too. So you can't use that. So what still exists? Who knows? But all right. So we have an interesting market going on, but it makes it really easy for you because the risk-free rate is still high enough. You can use the risk-free rate. So the risk premium for the stock market. So this is stocks in general. You lose a lot of points on paper 3 and on the exam if you talk about the market risk premium relative to your company. It has nothing whatsoever to do with your company. All right. This risk premium is the risk premium for being in stocks, not for being in your company. The beta is where we're going to adjust for your company. All right. So how much extra return do you need over the 10-year treasury to induce you to buy stocks in general? It's a very subjective number. It's called the required return on stocks. It's required to cover your risk. It's not a number you can go get anywhere. It doesn't exist. You can't look it up on Bloomberg. It's a theoretical number. So how do we get this number? So my whole career up until, I don't know, in the mid-90s or so, we use what's called a historical approach. That's Dr. Ibbotson from Chicago. So the historical approach is real simple. What did stocks return historically and what did bonds yield historically? And that difference was the market risk premium. So essentially what Dr. Ibbotson said is whatever the stock market got historically over bonds, that's what they needed to get. Now, is that obvious? Is it possible the stock market got a higher return than they needed? Could they have been positively surprised? They needed a 5% premium, but they ended up getting a 6% premium. Is that possible? Yeah, it's certainly possible. But Dr. Ibbotson says you go long enough in time and do enough information, then hopefully it all averages out, and what they actually got should reflect what they needed to get. But a little questionable. That theory disappeared. There was a famous paper, I'll actually even show it to you. I keep doing that. By Barclays, by these two guys. I don't know if they're still around or not. I guess it's 3 guys. Oh, Barton Waring. Oh my word, I haven't seen that name. I should email this guy. I actually met this guy. I didn't realize he was in this paper. His picture's not here though. How did he lose out on a picture? But so Barton, I'm gonna tell a story on Barton Waring since he's not here to defend himself. But I was managing a pension plan that loses a lot of money if interest rates fall.
So I needed an asset that was going to do well if interest rates fall. What kind of asset would do well if interest rates fell? Not stocks, but that's what Martin Marion was going to say.
Long duration.
Long duration bonds. But Martin Marion said you could use stocks. Why? Because he argues stocks have long duration. Why does he say that? Well, the discount rate includes the risk-free rate. If the risk-free rate falls, that implies stock prices go up. That's the last conversation I had with him. So I don't buy that. So 2008, interest rates fell dramatically. So stocks must have been up a bunch in 2008, right? What did stocks do in 2008? It crashed in 2008. So did stocks have a high positive duration? They might have, but the market risk premium more than offset it. So that's what my comment to Martin Waring is. I'm not going to put 60, 70% in stocks in a pension plan, thinking stocks are going to go up every time interest rates fall, because if you have a recession, interest rates fall, but stock prices also fall. So that was my last conversation with them. I haven't talked to them since. But this is their paper, very, very famous paper. So they call it one of the most important numbers in investing. I've heard it called the most important number in investing. I've heard it called the most important number in finance. It depends on who you talk to. So, there's people, it's an important number, this market risk premium. And how do they calculate it? So they calculate it using what's called the implied approach. And that was the first time I saw the implied approach. We started using it at UTSA immediately. It makes much more sense. So the implied approach, I'm going to do this in Word because I want to make sure everybody's really, really with me here. So the required return on stocks is the amount you need to compensate you for the risk of owning stocks. That's your required return on stocks. That's the number we need, but it doesn't exist anywhere. It's a theoretical number, but we need that number. And remember this word right here, because it's going to be real important to this discussion. The historical approach says, in the past, investors got their required return. So history tells us the required. The historical approach says, hey, just look to the past. What did stockholders get in the past? That's what they're going to need in the future. If they were happy in the past. So I don't buy that argument anymore, especially in the United States, because the United States has done much better than people could have possibly. I mean, think about the Great Depression, World War II. People weren't all that optimistic. They ended up with a pretty positive surprise. Think about Japan coming out of World War II. People were pretty negative on that. How did they do? Incredibly well the next few decades. So I think stockholders do get incredible positive surprises, so that the realized return can be much higher or lower than the required return. And if that's the case, the historical approach is going to give you the wrong answer. Okay. But for the longest time, we used the historical approach, Dr. Ibbotson. Dr. Ibbotson, he knows all of this. He knows all the approaches. If you Google his name, the market risk premium, he's all over it. I should show you, I think I might have told you this, I can't remember, but I should show the article he wrote where he was going through the history of the market risk premium. And it's a hilarious article with his name's in it constantly. So he's actually debating himself. So he'll say, as Ibbotson and all these other people said, blah, blah, blah. However, Ibbotson said this. And then a few years later, it's like he's talking about three different people, but it's all him because he's central to this argument. But he's the historical approach. I've met him a couple of times, really smart guy. There's a podcast where he was being interviewed. Now, an interesting story, since I'm telling you interesting stories on these people. Ibbotson, the podcast, he was buying bonds in the early 70s.
And he had two statistics no one else had. No one else had ever heard of. You want to guess what those are? Think two two letters that you've been saying over and over again in this class. Duration and convexity. He said no one knows anything else. He said buying bonds was like shooting fish in a barrel, or whatever the phrase is. He said it was so easy to beat the bond market because he had duration and convexity, and no one else had those two. That was back in the early 70s. So that's Roger Ibbotson. So now we have the implied approach. Why do I like the implied approach? Well, what the implied approach says is we can't get the required return, but we can estimate the expected return. We don't know what stockholders require the market to make, but we have a pretty good estimate of what they think it's going to make it. So how does that help us? So then the question is, does the expected return equal the required return? So if the market expects an 8% return and requires a 10% return, what's going to happen? I think stocks will make 8%. I need 10% to cover me from our risk. What's going to happen in that environment? Stocks are going to do what? They're going to fall until their price is low enough to give you what return?
At least
Give you 10%, right?
yeah.
No one's going to buy stocks if they need 10% and you can get 8. So no one buys, stock market falls, they falls just enough until you make 10%. What if the market expects a 10% return and requires an 8% return? Well, I think stocks will make 10%. I only need 8. What are you going to do then? Everybody's been buying stocks. What's going to happen to the price? It's going to go up until your expected return is what? 8%, right? So the argument in here is markets will adjust until the required equals the expected. That just makes sense. Why would someone buy a stock and make 8% when they need 10? It doesn't. They would not do that. They put their money in cash or in a bond or something. They wouldn't buy stocks. So that's the theory. So then the question is, what is the expected return on stocks? And guess what? You already know the answer to that, because you put it on exam 1. What did you say on exam 1? Surely y'all remember. Something from exam 1. You remember duration convexity. What's the second C? Credit, then the U. T. Taxes. S. I. You haven't forgotten everything. So then you went to stocks and you entered the stocks, you said the expected return on stocks is.
Did the required return was dividends?
Well, dividends is part of it. What do we say the expected return on stocks is? Dividend yield plus earnings growth. What kind of earnings growth? Nominal. Why nominal? Because if there's inflation, earnings will go up with the inflation, right? So stocks, some people say stocks are a good hedge for inflation. As you have inflation, their earnings will just go up. Bonds don't help you with that, right? If inflation, the bond keeps paying you 4%. But stocks, inflation goes up. They're going to rate. You've seen that with McDonald's and some other places. It's pretty shocking what McDonald's is charging for their product today, much higher. So that should go through earnings. This dividend yield Is it dividend yield or income yield? We'll have to talk a little bit about that. I'll give you a little bit of, I guess, because a lot of firms don't pay dividends. Instead, what are they doing? Buying back their stock. Do we need to put that in there? Yeah. When a company buys a stock back, its earnings per share will grow faster than their earnings because they have fewer stockholders. So that actually stock buybacks is one adjustment we may need to make. Then the question is, what is expected nominal earnings growth? And guess what? You did that on exam as well. What drives earnings growth? It's a function of what? We're talking about all stocks here, not your particular stock. Remember this from exam 1? Yeah, nominal economic growth. Which is a function of what 3 things? Productivity growth, labor growth, it's nominal growth. When you hear the word nominal, what do you need to add in? Not real, but nominal. Inflation. So you thought we are going to forget all the stuff in the first part of the class. Not applicable, it's still applicable. That's the expected return on stocks. Dividend yield or income yield, if you're going to add in stock buybacks. Plus expected earnings growth. Corporate earnings grow very much in line with the economy. So where does the economy come from? Productivity, labor, inflation. So if we look at this article, the return for stocks equals, what's that first number? Income return. Why don't they say dividend yield? Because they're going to adjust for stock buybacks, even back when they wrote this article, which is some time ago. So at the bad time, I'll show you another article. The world has changed. It used to be firms issued more stocks than they bought back. So it was actually a net negative. Today, firms are buying more stock back than they do net than they pay dividends. So it's actually shifted, that the buybacks has become more important. What's the second thing they have? Nominal earnings growth. And then the last thing they say is repricing. This is, I think, a mistake they make in this article. I might, if we have time, I'll get into it. But they say repricing. What is repricing? That's the stock market going either from overpriced to well-priced or underpriced to well-priced. And they say repricing here is 1.5% a year because the PE ratio from when they started to where they are now, that was an average 1.5%. And then I think they make a huge mistake at the end. I wish they were here. I would love to debate them on this because I think they messed up. Now they break up the nominal earnings and the real earnings and inflation. So they break it into the 2 pieces. So the rest of this paper is saying, what's the number here? What's the number here? And so you can see right here, D over P, that's the dividend yield. The change in S, why do you think they're saying that? I kind of hinted at it. So you got the dividend yield. So what must this be then? Must be stock buyback. So why do they say change in S?
Earnings per share.
Well, shares. So the S is per share. So what are they saying? The change in shares. Because if you issue more shares, you have more shares. So that's going to hurt earnings per share. That's one thing it's interesting to do is, go into Bloomberg and pull in firms' earnings and bring in their earnings per share and compare the growth rates. And what you'll see the last several years is earnings per share has grown faster than earnings because they've been buying some of these stocks back. All right, so dividends now, they don't just say stock buybacks. So it's really important. It's the reason this number is so hard to calculate because there's a lot of firms that pay out shares as compensation, like options and those kinds of things. You have to adjust for that as well. That's not a buyback.
These buyback shares, and it means the stock price is probably the case with it's out then. Or do
They don't, some firms only buy their stock back. Some don't pay dividends at all. It is a little different. When you pay a dividend, it is an income. And that's actually going to reduce their earnings going forward because they don't have as much money. But stock buybacks, it's
it gets a little tricky. It helps the people who don't sell their stock. Because they're now fewer stockholders, so they have a bit bigger share. But if you're one of the people that's buy, so it's a little tricky. It's not an easy number. The dividend yield is really easy to calculate. The stock buybacks is not. There's a lot of moving pieces. And then earnings growth, what do you think these two things are? Inflation and then real earnings growth. And then the last thing is the repricing. It's just the change in the PE ratio. So they say return on stocks is the income plus earnings plus repricing. We're going to ignore repricing. They didn't, I think, to their error. I think they messed up. But so there's their formula. So the rest of this paper is a really good paper. I should put this out there on Canvas. The rest of their paper is justifying each one of these numbers. So here's the historical numbers. Income return was 4.4%. Real earnings growth, 1.7, inflation, 3.1, and repricing. So stocks historically have made 10.7%. So the question is, why do you expect those numbers to be going forward? And that's the whole purpose of the rest of their paper. They go back to 1926. When you see 1926, that's Dr. Ibbotson. He's the one who went data. So 1871 is Robert Shiller, 1926 is Dr. Ibbotson. And Dr. Ibbotson goes back to 1926 for large cap and small caps. So he's kind of the source of small cap. In 1926, they weren't thinking about large cap and small cap. So he somehow went back and got that data, which would have been really, really tough to do. I don't know how he did it, but it does give us a really good history of small cap stocks. It's about the only place you can go back that far. Because even Robert Shiller, he goes back to 1871, but it's only large cap stocks. So it's kind of nice that we have that database. All right. So what does he say we can expect going forward? So he talks about the income return. He talks about real earnings growth. He talks about inflation. And then he does the repricing, or the three of them. And then he gets to his final answer, which I almost like. Here's his final answer. His income return was 2.25%. The way he got that was the dividend yield when he wrote this was 1.5%. And he added 0.75% for stock repurchases. That's how you got the 225. All right. The stock repurchases now is probably 1.5%. So you essentially can double the dividend yield for the stock repurchases. Expected real earnings growth is 3.5%. So that's productivity plus labor growth. 3.5. So that's, to me, a pretty significant number. Now, the question he asked is, well, they talk the same thing I talked about, that earnings growth has been slower than the economy. And they argue the reason for that is we're talking about the S&P 500. That's those 500 largest companies. It excludes all those small companies. And all those small companies are probably going to be growing faster than the S&P 500. So when you put them together, you probably get the economic growth. But 3.5 is a pretty big number, right? Because we said productivity, you could probably get 2% productivity. And labor growth has essentially been 0. So 3.5, that's a pretty significant. That's essentially what you would think the U.S. economy is going to grow. And I know the last quarter was much faster than that, but over the long term, I mean, you can look at the numbers. I think I showed y'all this last class, right? How do you get historical numbers? What word do I type? Fred? And we'll do quarterly, and we'll do percentage change. See, 1, 2, 3, 4, 5. All right.
one thing I like to do is if you do quarterly numbers or annual numbers, it's way too volatile. I like to use 5-year averages. I don't know if this will work or not, but we'll see. So there's our economic growth historically. This is real. I should put the years in there. Let me do that real quick. So 3.5 is where? Right here? Does 3.5 make sense? The last 20 years? How often have we gotten 3.5% the last 20 years? Pretty rare, isn't it? So 3.5, that's a pretty aggressive number, I think. We'd love, and Biden would love to average 3.5%. It's going to be tough for any major develop. I think even China eventually is going to 3.5 is going to start getting tough. So they say 3.5. I think 2.5, even 1.5 is not that far off. So it's been much slower. But you can see how you can quickly add some pretty good analysis into your paper just by pulling some historical data. Inflation, they say 2.5%. The Fed says 2%. If I'm doing inflation, they do the same thing I talked about. Use the tips curve. So if you want to know how to bootstrap the tips curve, I've got a video in our notes that you can watch. That's to me the most sophisticated way. What does the bond market say inflation will be long term? That's probably the best number. But the Fed says 2%. Do you use 2%, 2.5%, 3%? Why do you believe that's going to be? The historical average was 3%, but that's somewhat skewed by the 70s. And then they have repricing. So they said they thought stocks are overpriced. That's their mistake. Don't you wish the three of them are here? I'd love to debate Martin Waring one more time. So why do I think that's a mistake? Let's see if y'all can follow me here, because I think if you could bring this up in an interview, that you get the job like in 3 seconds. So they're saying the required return on stocks is 7.5% because that's the expected return on stocks. And saying that, they're saying the stock market's overpriced. So if you didn't think it was overpriced, your discount rate would be 8.25. That's what you really need to cover your risk. But they're saying, no, don't get 8.25, get 7.5 because stock market's overvalued. Now, if you use a lower discount rate, what happens to your valuations? Do they go up or come down? They go up, right? So you're valuing Apple or you're valuing IBM, and you use 7.5% discount rate, you get $130 and it's trading for $100. Wow, it's a really good stock. Or you use 8.25 and you get $80 and it's overpriced. What's the right answer? Well, if you need 8.25 to cover your risk, what discount rate should you use? I say you should use 8.25. If you do that and the stock market's overvalued, what are you going to discover? Most stocks are overvalued. If you believe the stock market, this may seem like an obvious question, but if you think the stock market's overvalued, do you want a discount rate that makes it look like it's not overvalued, or a discount rate that makes it look like it's overvalued? I want one that looks like they're overvalued. If I use 8.25, a lot of stocks can look overvalued, which is exactly what they're saying, which means I'm going to be much more selective in what stocks I buy. There'll be fewer stocks for you to buy. So I think they made a mistake subtracting out the 75. They should have left it in at 8.25 and just realizing a lot of stocks are going to look overvalued because we think the stock market's overvalued. So that's the one issue I want to debate with them. So I wouldn't use the 7.25. I would use the 8.25 and I would add that back in. They ended up being right because after they wrote this paper, we had the 2000 stock market crash, and the stock market did. They thought it was going to decline 0.75% over the next 10 years. Instead, it did it all in 1 year. So they were like right, but not. It was too fast, faster than what they thought. So it's a good paper. It's a little dated. So how do you get these numbers? So dividend yield, you'll see it in the video. I just use the yield on SPY. You may know SPY. So is that State Street or BlackRock? SPY. And I've seen the spider lifting weights. Have you seen that? Do they still do that commercial? So SPY, the spiders, is that State Street or BlackRock? iShares and spiders, which is which? And vipers. They're always, so if you start your own firm, you know, like finding an insect, it could be the beetles or something, but spiders and vipers, I guess vipers are reptile. I guess the firm that did vipers, whose name starts with a V as well, thought vipers eat spiders, so that's probably why they picked vipers. So y'all figured it out? Spiders, State Street, iShares, BlackRock, Vipers, Vanguard. All right, so those are the three pro shares. You can do the others. So Spiders is the exchange traded fund on the S&P 500. And so its yield is essentially going to be the yield on the S&P 500. So if we do the SPY, you can see its current yield is 1.52%, almost exactly the same yield as when those guys wrote that paper 23 years ago. So we're back to square one. The buyback yield, well, I actually recommend you add something for the buyback yield because it's going to make your paper four much better than you're going to have a problem if you don't do it. And we'll see why when we talk about paper four. But Dr. Ibbotson, y'all have heard of his name before? So here he is on another paper. Long-term drivers, stock returns, total payouts, not just dividends, but total payouts, dividends and stock buybacks. And that's what they're talking about here in this paper. I should probably put both of these papers out there, not that you would read them all, but here's what they're talking about. Here's the dividend yield, the green, and the blue is the buyback yield. And what do you notice about the buyback yield? Sometime last decade, the buyback yield caught up with the dividend yield and passed it. And I did some numbers recently, and it's stocks are still buying back more stocks than they're paying in dividends. So that's still the case. What's a little strange, though, is they're borrowing a lot of money to do it. So if they borrow money to buy their stocks back, I think that actually changes the equation some. But they're still buying back more stocks than they're paying in dividends. So that's still true even after this article, probably even more true. So how much do you add back? This article implies, again, this is not, you don't look at the buyback, you don't look at the dividend yield. This is where you lose a lot of points. It's not the dividend yield of your stock. All right, when doing the market risk premium, it's the entire stock market. It's not the buyback yield of your company. You don't say, "Oh, my buyback yield is zero because my company doesn't buy stock back." We're talking about the entire market. So that buyback yield he recommends is also 1.5%. It's pure coincidence. They're almost exactly the same. All right. Now I can go in and get buyback yields out of Bloomberg, but I can't adjust for those employee stock options and all that other stuff, which this article does. So this article is complicated because they have to make a lot of these adjustments that are really, really, really tough to do. So that gives you an income yield of what? About 3%. So why do I recommend you use 3% and not 1.5%? Well, because if you use 1.5%, you can get a discount rate that's so low, it's going to give you ridiculous valuations for paper four. So I'm just for your benefit, use the buyback yield. I can't remember what I did on the video, but I think I did put the buyback yield in there. And then economic growth, I think 4 to 6%. to me makes sense, but you got to write about that and figure that out. 4% on the low end. You can see that article I just showed you, they said 3.5% for real. Then you add inflation, they're talking about 6%. They're at the upper end of my range. 6% I think is pretty aggressive. 4%, 4% is like 2% productivity growth, zero labor growth, and 2% inflation. So that's how I get that 4%. I don't think you can go below that, but 4 to 6, I think is, and that's nominal. That's not real. I remember Trump was talking about what? He's getting 4 or 5. I forget what he said. Maybe he said 6% GDP numbers, and no one was really sure if he meant real or nominal. 6% would be a ridiculous real economic growth. It'd be all pretty high end on the nominal. So you always have to know we're talking about nominal. That's why I keep bringing that up. This chart I'm showing you here, this is real. So you have to add inflation on top of that, all right? So make sure you keep that in mind. I like to do the real and add inflation because if you do the nominal, you got the 70s with the high inflation, you get really exaggerated numbers. Unless you think we're going to have 12% inflation, again, that's kind of old history. So I like to look at the real and then put my current assumption for inflation because that's a much more reasonable number. So what does that give you for an expected return on stocks? Can be 3% plus 4 to 6% or 7% to 9%. Now, why did that article show the history was over 10%? But over 10%, that includes inflation at 3.5 versus you're probably going to use 2.5. And it had a dividend yield of 4 point something percent. We're using 3. So between the dividend yield and inflation, that gets you from the 10% down to 7 to 9%. Right? I'm not telling you what you use for papers 3 and 4, but I am saying if you're outside of that range, you're getting a little extreme. I don't count off our extreme unless you didn't justify it. So if you tell me you think stocks should make 12%, that's fine, but you better have it documented in a way that you prove it to me. Otherwise, I'm just not going to buy it. I've had some students say, well, the last 5 years, stocks have made 12 and bonds have made 3. Now, this is long term. You can't use just the last few years. That doesn't make sense. So if that's the expected return on stocks, and let's say the risk-free rate equals 4.8%, what is the market risk premium? It equals the expected return on stocks minus the risk-free rate. So equals 7% to 9% minus 4.8%. So whatever that is, so 2.2% to 4.2%. That seems low. Now to talk about what the mortar end says, but that 2.2 is way too low. So you probably want to push up more. I don't think market risk premium should be below 3. So if you're in that 7 to 9% with a 4.8% treasury, you probably don't like stocks right now. You're probably saying that's the expected return, but boy, I need 9%. I think stocks will make 7, but I need 9. You'll just be avoiding stocks. So I think that's the case. If you come up with 7, that's why I got to get back to this word up here. If you think stocks are only going to make 7, you're probably not buying stocks right now because you probably require something closer to 8 or 9%. Right? So this is your paper 3 to get your discount rate, but it's also going to go into your paper 4 because you're going to need that expected growth in earnings for your paper 4. So you're going to be using this number in both papers. All right. Any questions on that? You'll see it in the video as well. I do all this again in a video. Now, why did I highlight the word you? In all of your college classes, you should challenge some of your professors on this. I'd be curious what they would say. All your college classes are trying to find this market risk premium. But they're not trying to find your market risk premium. They're trying to find the market risk premium for the average investor. But what do you care about? you own personal one. No one's ever, I've never seen a paper on what your personal market risk premium should be. You can come up with what you expect stocks to make, but that doesn't tell you what you require them to make. What do you personally require stocks to make? Who knows? You've got to figure that out. And we can't figure out. So what most people do is say, well, let's figure out the average person wants and that'll be mine. Well, that doesn't make any sense. If you're lower, if your risk tolerance is lower than the average investor requires 8, and you're probably requiring 9 or 10. So you've got to figure that out, but no one ever tells you that. We just assume everybody's like the average investor and that's what you want, but you can come up with your own number. So you can come up with the expected return on stocks and you can decide what you need stocks to return. And that's, you can use whatever discount rate you want to use. You don't have to use this particular model. So ask your professor, wait, is that the market risk premium for the average investor or for me? How do I get my market risk premium? And I'd love to hear, y'all tell me that I'll dress up as a college student. I have to wear a mask and come in. I just want to hear them give that discussion, what that means, because it's not a question I ever hear asked. This article doesn't ask that question at all. They don't even address it. They just say this is the market risk premium. For whom? And they don't say that. It's just for whoever needs one, this is it. So if you look at the Motorin, I got this updated through I think this is through September. The blue is the risk-free rate. You see how it got down to historical lows back in 2020. And the light blue is the market risk premium. So he says, he calls it ERP. Why do I call it MRP? What is he doing? At the market risk premium, he's doing the equity risk premium. What's the difference? There isn't any. Right? They're exactly the same thing. Market risk premium, equity risk premium, the exact same thing. I actually switch between the two of them all the time. So he said 10 years ago, the equity risk premium was 5.59%. The 10-year treasury is 261. The expected return on stocks was 8.2%. Last year, the equity risk premium was 621. Bonds were 382. The expected return on stocks was 10%. Why? Because inflation was so high. It wasn't that you're making more money. You're making more money, but you're losing it to inflation. This year, he says the ERP is 482. Bonds are 558. They're a little higher than that now. And expected return on stocks 942. He's higher than I am. He has a higher number than I do. So I tend to have the market risk premium in the 3 to 4% range. He has it frequently over 5%. But you can see over time what he has. The top of this is his expected return on stocks. And you can see it, his ranges between 8 and 10. I said mine ranges between 7 and 9. So he's a little bit more aggressive in his assumptions than I am. Now, does he have stock buybacks in his number? My guessing is he probably does, but I haven't actually looked at his numbers. But he's doing the same thing. Dividend yields, probably stock buybacks, expected earnings growth is the same implied approach.
If he didn't have stock buybacks, wouldn't his number be lower than?
Well, unless he just has some really high earnings growth. Now, my earnings growth was 4 to 6%. He tends to use the 10-year treasuries for his earnings growth. So he's probably closer, he's below 5. But since he uses, well, I don't know how he got such a high number here if he did that approach. So you'd have to go back and look at his numbers. The nice thing about it, sorry, my spam phone calls have become much more popular with spam calls. Every once in a while, I'll take one just because I want to be mean, because I'm in a bad mood and I'll chew them out. But now it's a computer, right? Can you tell when you're talking to the computer? It's so friendly. It's Tiffany or whoever, and they're so friendly. All right. Anyway, so it's all there. He shares everything. It's wonderful. The Motorin, just kind of like I do. I just put everything out there on YouTube. He shares everything, nothing to hide. So you can go look at the numbers. He'll tell you how you got these numbers. I'm pretty sure he's using the implied approach because that's become pretty popular. If he was using the historical approach, his numbers would not change that radically. And I think the biggest driver is probably the inflation number. So the key for you is to understand the concept that you can talk through this. So the implied approach just assumes markets are efficient. We don't know what the required return is, but hey, we can guess on the expected return. Once we get that number, we'll just apply, assume that it's the same as the required return. And that'll give us our market risk premium. Remember on the exam that you got to take that expected return on stocks and subtract the risk-free rate. Some students forget to subtract the risk-free rate. So you've seen it in some of your classes. Market risk premium equals, I say, the expected return in stocks minus the risk-free rate. That's the way I have it. And then you'll see CAPM equals the risk-free rate plus beta times the market risk premium. But sometimes you'll see CAPM so I don't want you to get confused. Some classes do it like this. So what are they saying? Required return. Yeah, required return on stocks minus the risk-free rate, which is what? Market risk premium. Some students get, especially on the fact exam, the fact exam does it the second way. So it doesn't matter. If you have the expected return on stocks, then you subtract out the risk-free rate. If you're given the market risk premium, then you just use that. You don't have to subtract anything, right? So don't get confused. They're the same formula, just one's a shortcut. I've always done it this way, mainly because once I get the market risk premium, I just have the market risk premium. And I know that number is between 4 and 6, or between 3 and 5 probably right now. So I tend to just use that number. But you could do this if you want to do this, 8% minus 4.2, whatever. So either works. Just make sure you do that. Your expected return on stocks is 8%. Make sure you don't use 8% as your market risk premium. All right. Next class, what we'll do is that's the paper 3. Next class, we'll go through the valuation models. So we'll get paper 4 pretty well.